All right, all right. What's going on, everybody? It's Friday. Yeah. So I hope y'all had a good week. It wasn't that bad, for an FOMC week. Yesterday is what I expected FOMC day to look like, but it's all good. We um we still have the risk of the government shutdown, and the market is still reacting to the various news events. One of the events that sent the market down last night was the president announced he had made his decision for the new Fed chair, but he didn't name the guy last night. He just described the guy last night. And then this morning in the pre market, before the market opened, he tweeted out the name of the guy. But his description last night was already good enough that most people was confident that it was going to be this new Walsh, whatever. Bloomberg, who I listen to every morning, was talking about how they were really confident it was going to be that guy. And then when Trump tweeted this morning that, yep, it's going to be that guy, they were talking about it again. And you could see the market responding to the tweet about the guy as it was happening. So, are we 100% certain that that's what caused the market moves? No. And I'm sure that wasn't the only thing that did it, but that was a big piece of it. So from last night into today, at least through the Globex session, some of this shenanigans in that time frame was because of the new Fed chair announcement. Not all of it. A lot of the sell off yesterday had to do with volatility from different areas. Now, I think that's important to understand, even if it's just the bare minimum of correlation, because next time it might not be from the metals space, it might be from the yield space. And that's usually what does happen. Usually, it's something in the FX markets like Japan or something out of Europe, and they cause violence. We get what they call FX volatility, and that volatility bleeds over into equities, and then we get equity volatility. What happened yesterday, I think, was a bleed over in volatility, but it came from the precious metals space, which in the current environment still means it came from the FX space, anyways, since I'm really a firm believer that the carry trade unwind, or just the carry trade in general, um, is different now because we're not seeing repatriation of money. The old idea that money goes home, it isn't going home, it's going into precious metals. So when precious metals got too violent, we see them getting unwound, and we saw that same volatility coming into equities. That's a bleed over. These are three distinct categories between commodities and FX markets and equity markets. And it's not often that all three will go up or all three will go down. And a lot of times, one of them can cause the violence that bleeds over into another group or another category. Because in the end, all these markets are connected, right? Even tangentially, they are connected. And we might not always be able to connect the dots very easily, but if you dig deep enough, there's always a connection. And when things get really extreme, that connection stands out more, right? So today's been kind of a nasty day, but that's not really a surprise. We had no expectation for today other than that we were going to sit inside of yesterday's range. And I mentioned in the pre market that the range was really big, and that sucks for us. and that it probably would be a nasty day. And yet here we are. I should have highlighted better in the morning briefing that we're still in the first box, and if we didn't even get out of that box, it was going to be an even nastier day, so that maybe people would have just left it alone and not messed with it so much. Is it tradable? Sure, anything's tradable, right? Like anything is tradable. Just how much do you want it and how much risk are you willing to take? That's what it comes down to in the end. And what I found for myself over the years is if it looks like poo, I really don't care to trade it, because there will always be something else later that I am willing to trade, and I'll just do that instead. But, FOMO is a real thing, and it gets people caught up, gets them in trouble. You can see the Globex range on this chart really well because it's the volume profile there. And we are inside of that very first box, the box that I draw every day in the morning briefing and say GTFO. You have to get out of that box if you're going to do anything else today. And as long as we're still inside that box, then your opportunities are going to be severely limited. And honestly, you're just really handicapped. So, if you find that trading the futures is difficult and you're losing more often than you win, quit doing the hard stuff and you'll find that life's a little bit easier, right? Trading in this environment is what I would consider the hard stuff. Narrow ranges, inside days, choppy, violent, with no market direction or bias or benefit, and on an FOMC week or an event week, right in front of a government shutdown, after FOMC, before QRA. There's all these things that are piling up. Last day of the month, where we look at it and say, why would they even bother coming in on a day like this? Anybody want to jump in front of weekend risk when we've been getting risk bombs for the last 4 weekends? Not me. So why would they come in and pile into the markets right in front of all that risk? They wouldn't. And if they're not going to come in and trade, then why would the markets move? They didn't. It's not a surprise. Surprise. We got a number of topics to hit on today. Some are mine, things that I wanted to cover because I've had people ask about them before. And then some are requested from the community with varying levels of the amount of time that it might take. So let's work through those first. And if there are requests or topics you guys want to cover, as always, just hit me up. If we have time, we'll get them. And if we don't, we'll just add them to the list, right? It's not a big deal. One of the topics on the list is to do an evaluation on various stock. So we got a Tesla bear trade theory. Now remember, when it comes to taking a trade, time in trade has to be a part of the discussion. So it's done with earnings. We got that out of the way. What kind of a trade are we looking for here? 6 days, 6 weeks, 6 months, 2 years? Knowing how long we're willing to take the trade helps define whether or not this would be a tradable opportunity, right? So let's look back at the question here. Well, the question uses the weekly chart, so I'm going to assume that we're going to go out for a few months at least. Let's say getting out before the next earnings, right? I don't think that's asking for too much. That's April. So we would need to skip April and use the May contract so that we can overshoot, right? We don't want to use options that are going to expire around that same date. So we have to jump it and go to May with the options, or we have to front run it and use March options. Rather than trying to guess now which one we would use, we'll just look at both of those choices when we get into the options chain and let the data tell us which one of those would be a better choice, right? I like to do it that way. That to me makes more sense rather than just thinking that I just already know the answer of where we're going to put a trade on, and and that way we're a little more flexible, right? So maybe March, maybe May, but definitely not April because that's where the next earnings is at, and we don't want our options to be those options, right? So, is there a short opportunity on Tesla? And if there is, what would it look like? Start with a top down. When we go to the bigger picture time frame I'm on a monthly here. You can see this very large wedge, and it's a really large wedge, right? It goes all the way back to 2022. It goes as low as $100. It's a really big wedge. Plus, this is a log scale chart, and if I was to turn off the log, it maybe won't look like this. Did anybody else lose audio? I've been having audio problems, so I'm kind of watching really closely on this. Yes, no, hello. All right, thank you. It's I was talking to somebody last night and my audio fell out, so now I'm really kind of twitchy about it. I appreciate it, guys. Thank you. So, would it still look like this wedge if I wasn't on a log chart? And does this log chart wedge have any value? I mean, to me, it does. For a swing trader, a big picture, to me, it still has value because it shows me what the big trend is. And the big trend is still good. While we're out here, we can do a little bit of analysis. This isn't going to help, like pull the trigger on a trade, but it's going to better help us understand what's up with this stock. We've got this zone back here with this wick and this wick, and we can see that the market has really struggled above 450, right? So we know if we was looking for longs that 450's got a lot of trouble. And we can see the first time we got up there, it sold off really hard. The next time we got up there, it has started a sell off, but we don't know how bad that sell off is going to be yet because we're on the very next candle. And well, that candle is still an open candle, at least for one more day. Next week, we'll be in a new month, and then this candle will be closed, and we'll have to figure out what we're going to do from there. What we can say right now is we are through the midpoint of that bar. And so far, it looks like we are at the mid or close to the mid on our current month's bar. If we're looking for a short opportunity, we want to stay below the mids, right? We want to stay below the mid of this one, and we want to close below the mid of this one. When the new month opens, we want to continue to go to the downside and stay in the lower part of this bar. And our concern is all of this buying and all of this buying. It seems that they're protecting this thing when it drops down too low, say around that 425 area. Every time we get below 425, they seem to buy it back up again, right? So we can see that we're in a bit of a collar. Now, on the monthly, it's hard to see that collar, but we can just see the wicks. It's a good place to start, right? I wouldn't take a trade just because of the monthly, but the monthly does give us some insight. So now we're on the weekly. We got this angled trend line. We don't really need to draw it. I've noticed that when people try to draw the line and then it doesn't work right and they get frustrated and think they're doing it wrong? You're not doing it wrong. You can't do it wrong. And for me, a lot of times I'd rather just not draw it. My eyes can see that we're running up this line, whether there is actually a line there or not. So don't worry about it. If you draw the line and it doesn't match perfectly, don't get all OCD and fight it. Just uh, use the old school trick where you start the line at the open of the candle that you want and you stop the line at the close of the end of the candle you want. That trick right there can help solve a lot of problems, and it helps you stay uniform, and it'll look a little bit like a Linreg line more often than not. So don't struggle with it, but you can see the trend line, and we are breaking or testing that trend line. We got underneath it last week and we came back up, and we got underneath it again and we came back up. And this is earnings week, so there's always a lot of drama and threat, but there's also new data. So if we're looking for a short trade, we would be able to go through the data and say, hey, how was their earnings? Was the earnings good? And I don't remember everything about the earnings, but I do know that they're going to discontinue two of their cars, and they're going to turn those production lines around and start making robots, I believe. It is important to understand what was going on with the earnings if you're going to take a swing trade to the next earnings, because we want to know, hey, what was their forward guidance? What kind of spending did they do? And did they say anything about what they're interested in changing and all of that stuff, right? So when you're thinking about getting into a trade and a company is near earnings or just had earnings, take the time to figure out what happened at earnings. In this modern world, you have life so easy because you can just reach out to AI and say, hey, AI, Tesla just had earnings. Tell me about it. And it's going to give you everything you need. If it's too sophisticated and it's giving you information that you don't understand, you can tell it, hey, that's a little over my head. Dial it back. I'm new to this. I don't understand what you're saying, and I need you to feed it to me in smaller bites. And it'll do that. So you can get it at whatever trading level you're at so that you can understand what the risk is, right? The market didn't sell this thing into the dirt. And to me, that's like the biggest takeaway. If they'd have had a really bad earnings, then it would have just been dumped on its head. And well, we didn't get that, right? So it wasn't that bad. So that's a good start, but not bad doesn't mean good. And if we're looking for a short, why wouldn't it have been? If we were looking for a short, we would have wanted it to fall on that earnings announcement, and it didn't. Now, that doesn't mean that we can't continue to go down from here, because of course we can. We can go lower. But if I was looking for a short, I would have wanted to see that weakness already, right? There's previous earnings where we didn't sell off on the earnings week, but then we did over the course of the next few weeks. So I don't want to, make it sound like since we didn't sell off, we don't have a short, because here's a really great example. And another one, here where we had a little bit of a sell off and it continued for the next 2 weeks after that. So, you know, it doesn't have to just crash and burn for us to have a short. This had a really good TRB, trend line breakover, for a roll off from the top. Nice short. And so did this one, but before the earnings, right? Now we're all the way down here. So are we going to get the continuation or not? Remains to be seen. Now, do we have a signal for a short just from what we have seen so far? No. But you do need to decide as a trader, are you going to wait for a signal to get that short, or are you going to get the short without a signal? I don't like to buy options in the direction that the market is already going. I will do it. I've done it before, and I promise I'll do it again, but I don't like to if I can help it. So I'd rather buy puts on green days and I'd rather buy calls on red days just so I can get a better price. And it helps because if I'm wrong, I won't lose as much money. So it's a little bit of a risk defense, but we don't have to do it that way. We can sell it, we can buy puts when the market's falling, or we can buy calls when the market's running. But the next piece of it is, do we wait for confirmation or do we get in without it? There's an old phrase that says you pay for confirmation. Confirmation is not free. And that's really true. If you wait for confirmation, you will miss some of the move. You will very likely also have to use a bigger stop, and the options will be more expensive, which means when or if you did take a loss, your loss is going to be bigger. That's what they mean when they say waiting for confirmation is expensive, that it's you have to pay for that confirmation. But a lot of people like that approach because they lose less often. Now, me, I don't care about my win rate versus my loss rate as much as I care about how much I lose when I do lose versus how much I make when I do win. So I'm more about how much is at risk versus how many times do I win or lose. Everybody's got to make that decision on their own. If we're looking for a short signal, I don't see one. Well, what I need to see, we would have to get below that trend line and keep it. We would need to close in the bottom of one of these two wicks or just get completely underneath those two wicks and begin the move to the downside. If we did any of that, then we could say we got a short signal. Now, do we have reasons to put it on a short list, keep it on the watch list, maybe anticipate that we could break down and get a short? Sure. This is the measurement of the last leg here. And you can see that we're underneath the half of that leg. To me, that's a really good reason to keep it on the short list. That doesn't give me the reason to take a trade, but if I'm looking around for things that are setting up for an opportunity, that would be a setup for an opportunity right there. We're underneath the half, and all I got to do is get this breakout, and I would have a short signal. So, of course, you can get in before it gives you the short signal. We covered that, right? That's the difference between waiting for confirmation or not. So that's Tesla. And then we have Microsoft. Same thing. We've already reported. So if we look forward, we have to avoid the April options. Well, we don't have to, but my approach, I would avoid the April options. I would be looking for either the March or the May, but not the April options for a trade. Now, unfortunately, this already made a really good move because we had to wait for today to do the analysis. It had the earnings, got kicked in the face, and now we're down here. It's already been from one earnings to the next a significant decline. I really don't anticipate 2 quarters back to back of Microsoft getting such significant declines, especially since the previous quarter, right, from August to November, was like a digestion quarter and then a negative quarter. And now here we are, here we are. It's possible that we could continue to bleed from here, but my expectation really would be that we do something like this last one, that we digest like this, which, that could put us down to 400 or even 380 before we eventually form this sort of a cup behavior, right? We don't have to go that low, but it's on the table. So if we're looking for a short here, do we have enough information to get a short? Yeah, but we made this massive drop, right? And that spiked all of the options prices, especially the puts. They're really expensive right now. And if we tried to buy one and we're wrong even a little bit, they're going to rip our face off. So trying to get a short from here right now is going to be a difficult thing to do. It'll work out well if it just drops like a stone. Great. Our options will make money. But if it grinds lower, or it wants to try to close this gap first, or does anything other than just fall like a stone, we're going to get hurt pretty bad. And we're going to have to hold on to that loser for quite a while until it eventually begins to recover, right? So if we're looking for a trade here, I would say look for a sideways trade or a long trade because it's very likely we're going to go up first before we go down more. Bring it over to a chart with moving averages, right? On the weekly, we can see that we're underneath the 50 period weekly moving average. And that's kind of a big deal because Microsoft is one of uh, the blue chip babies, right? It's the one of the sweetheart companies. Now we're still above the 200 and we're below the 50. And that's weakness and a lot of reasons to be looking for a short signal. But we've got this really big outside bearish engulfing candle at the bottom of a range. You would normally want one of those up at the top of the range, and then you get your sell off. So we don't want to use this candle as a reason to go short from here because we're at the bottom of a range. And so we'll just look at that and say, well, it's an outside bar, it's a lot of risk. And we failed to close above all of those moving averages. We just got the beat down, right? If we want to see a long opportunity, then we want to focus on the candles itself. Getting back above the half, which is like $450, offers us a chance to go to the 50 period moving average. That's 472. It's a 20-point move. Now we don't have to wait. We could just get in now, and if it doesn't go up, then we just close our trade. If we're looking to go down, we can get in here now and just make sure that it doesn't get above 450. That'll be our line in the sand to say, all right, I'm going to stay short, but my stop or my level to get out is 450. If we wanted to tighten that up, then we can look at the daily for a short. Let's use a different one here. For a short, we would want to get under that midpoint and we'd want to stay under that midpoint. We don't want it coming back up and closing up here somewhere. You could do your trade in stages and say, well, if it gets back above that mid, I'll close half my position. And if it breaks through the top, then I'll close my short, right? If you were going short. If you take it the other way around and say, I do want a long, great. You can wait for price to get above the mid. That'd be your trigger long. And then you can add to your position once we break through the top. And the goal would be to close this gap. Now, it is an earnings gap, and those can last for a long time. But when it comes to taking a short in something like this, in a blue chip company, it's been around for a long time. Um, and it's already bled off this much, I would be careful of a short. right? This is still a well-known company that isn't broken, right? Like this isn't UNH. UNH had some serious problems, right? And they still do, to be fair. Microsoft had a good earnings. It just didn't satisfy investors. Uh, You know what I mean? Like this isn't a long-term beat it down, seeing Microsoft go to $200 kind of thing. So how much lower is it going to go before the institutions say, you know what, screw it, I'm going to pick up another 8% of Microsoft because it's so damn cheap and it's still a company that I believe in the long term. That's the risk, right? Is that at some point it's just going to get cheap enough that the institutions just come in and buy it just because it's so freaking cheap and it's such a great company. So careful on the short. If you're just looking for, some getting nimble in and out plays, then short it as it crosses the mid and stay in your short as long as it's under the mid, and then target the low of that earnings bar as your first target, and then just use your measured moves 111, 1, 2, 3, 6, and whatever on the way down. We didn't get a gap and go, right? That's worth considering too. If you get a market that gaps and runs, that's one thing. And even this one, I guess if we look at it, it didn't gap and go either at first, right? We gapped, and then we had 1, 2, 3, 4 days where we closed inside of that breakaway bar. So that wasn't a gap and go either, really, but it stayed in the upper half of that bar. Let's put the midpoint on. So traders that went long on that big expansion there, as long as it closed above the half, they were good. And it eventually broke out and got some work done. So that's something to consider now looking at it from the other side, right? Put that mid back in place. And if you're looking for shorts, keep it under the mid. If you're looking for longs, get back above the mid. When it comes to putting on a trade, I try to look and ask questions of the market. It doesn't mean that I ask the right questions all the time or that I even get answers to my questions, but usually I just start poking around and trying to understand as much as I can, how did we get to where we are, so that I have a better idea of where do I think we're going next. Sometimes that's really clear and those are the trades that I like to take. And then other times it's muddy water where I'm sitting there really struggling to try to identify where the hell are we going? And those are the ones that I usually just walk away from because there's so many really good trades that we can take. Why do I need some wishy-washy, maybe kind of sort of it might work trade? I don't. So I don't, right? I found that to be really useful over the years that if I can't see it, I don't want it. Just leave it alone. Can we trade it? Yeah, of course, yeah. As long as we can define our risk, we trade anything. All right, I'm gonna jump over to SPY for a moment, or the ES, so that I can draw my fib because I don't want to lose my fib drawing. This is the fib that I use with the. It's not even really fibs; it's more of a quadrant than anything else. But I got my colors that I like, and I got my lines and my. It's exactly how I want it to be, so I don't want to lose that. Now we're just going to go somewhere else so I don't accidentally delete it. There was some questions about using the fib, and so we're going to get into that a little bit today. Now, there's a lot of books about Fibonacci that are out there, and um, while I don't trade the way that the books talk about, I don't even use the fib the way that the books talk about. That doesn't mean that the books didn't have any value, right? The books have a lot of value because it helps you better understand what the heck this tool is, right? I thought I just changed that, but I guess not. Let's try that again. Ah, I hit the wrong one. Now we got it. All right. So I reset my Fibonacci back to the default. So if you was to use your Fibonacci, depending on what broker you're on, this will be the kind of Fibonacci that you ended up with. Now, some brokers, when you go to draw the Fibonacci, some of them will always have 100 at the top. That's really important to understand because on Thinkorswim, I can make 100 be at the bottom or at the top, and it just depends on how I drew it. All right. So with this one, if I start at the bottom and I end at the top, 100 is down there. But if I start at the top and I draw down, 100 is up there. I choose which side gets 100 based on which direction I start the drawing. Okay. But on other brokers, some of them, no matter how you draw it, 100 will always be at the top. So if you have that kind of broker, then you just want to get used to using some of the mid lines because that's kind of what they're for, right? So these are the fib lines. 618 is the Fibonacci number. It's the real one. All the others are just tools to assist the 618. And the idea behind this is that you want to capture something. In the textbooks, they'll say capture the highest point to the lowest point. You take your chart to a 1 year daily, um, a 3 year weekly, or a 5 year weekly, and you just snap your fib from the highest point to the lowest point. Now remember about that 100. Since we're always following the textbook's example and we start at the top and drag down, that puts our 100 at the top every time. If you do it the other way around, your 100 is going to be down here at the bottom. And it's not a big deal. It's just that's what you would end up with. So the textbooks talk about that 618 as your magic Fibonacci level. And as you can see, a lot of times that's the measured pullback. It's not the level that I use, but we're just talking about how do fibs work and how to use them. You apply them from the highest point to the lowest point, and for the time frame of the chart that you're using, that should cover everything that price is doing. If price was all the way up here at the top, then it would still fit in this. And if price was all the way down here at the bottom, it would still fit in all of this, right? So no matter where price is, drawing it this way will capture all of price. We can now use this looking at no matter what happens next, price is going to hit one of these lines. If we get above 786, it opens the door to 100. That would be where we want to go. If we get below 618, it opens the door to the half, and that would be where we would want to go. So it can define your line in the sand, bullish above, bearish below, where's the next target, destination, it's all there. And that's how you would use it. What if we break out? we got levels for that too. They're built into the system. There's your next target. Now, some brokers might have levels a little closer. Some of these in between levels could be up here, especially if they've built in something like the quadrant lines, right? So you can get, say, a 1.5 in there, and 1.25 might be in there. So now, if we were to break out, we've got those quadrants that we could hit as well, right? So if your broker has the 1, 2, 3, 6 and the 38.2 and the half, then you'll have all of those filled in. I think that's what TradingView does. The first time you open up a TradingView Fibonacci. Can't quite remember on that. But you just want to get used to whatever broker you have. So that's how it's used. Now, along the way, people have taken it and turned it into their own little playground, like me, for an example. And then, the sky's the limit. You can really do whatever you want. I took these quadrant lines and I mixed them with my Fibonacci lines and I made my own thing. I don't want to lose my quadrant line drawing, so I'm going to hide it over here for a minute. Now I'll reset my quadrants. All right, so these are default quadrant levels. And as you can imagine, since the quarter word is in quadrants, they're broken down into 25s. 7, 8, 6, and 75, really close together. 23.6 and 25, they're really close together. So, you could just use quadrants, especially if you're like me and you don't use the 618 at all, ever, period, like me. I never use 618. Never. Well, if you're not using 618, you're not using fib, right? So you might as well just take it and throw it in the trash and use quadrants. Since most people know the word fibs or Fibonacci, even if they don't know how to use it, they recognize that way more than if you say, yeah, I'm using quadrants. That usually confuses people. So I still call my lines Fibonacci lines, but they're not. They're bastard versions of the quadrant lines, really. But you would use this the same way, right? So you go out to your 1 year daily or your 3 year weekly or your 5 year weekly, whatever it is that you're using, and snap it from the highest point to the lowest point, and you would do it the same way as you would with your fibs. If we get above 75, then we want to target 100. If we're below 75, we want to target the half, right? Same idea. Now, all of that was the textbook version of how do we use these lines. And in everything that we were talking about, it was more of analysis than anything else, right? Notice there's no trade trigger here. There's nothing that says, oh, well, it crossed that line, so now get long, or it crossed that line, so now get short. These are there to help you define levels to continue to look for bullish opportunities or to begin looking for bearish opportunities. It crossed some, line in the sand. And so we want to swap our bias and take them. Exactly right. You got to watch price action and maybe see a candle pattern or order flow or something that says, yep, now I'm going to get in and I'm going to go long or short or whatever. The trade doesn't come from the lines or anything like that. The lines are just our analysis. Yep. So we want to use these to provide information. Some of the information that I like to know is after we've had a run, how far did we pull back? And is the pullback too far? Well, what's too far, right? I want to be able to define how far is too far. Because when I go fishing, I swear I catch a fish and it's this big. How big is big enough? When it pulls back, how far is far enough? And how far is too far? When we are in a trend, markets have to pull back if we want to stay healthy. If they don't pull back, we don't stay healthy. Volatility gets out of control, and then we go parabolic and it crashes and burns. So we do want pullbacks, but we don't want too much of a pullback. And when it does pull back, it tells us a lot about the traders that are participating. Some are taking profits and cycling out, and others are happily taking their place. They were patient, they waited for a pullback, and now they're getting in. And so the pullback doesn't come back, quote, too far. But I want a way to make it uniform so that I can always gauge exactly how far it did pull back. In the old days, they used that 618. And that made sense because they were trading using week old newspapers or they were, trading using yesterday's data. And then times got even better and they started using 2-hour delayed data and 30-minute and 15-minute. And now we've got price that we get price discovery in nanoseconds, right? We don't have to wait for data like they had back in the day when they were sending smoke signals and telegrams for price. We don't need to wait for 618. When I'm seeing a pullback, I don't want it to get below 75 or 78 if I'm using my other levels. Participation should be aggressive enough to buy the dip and end the pullback before we get so weak or we drop so deep that we cross that level. So if I look at Apple and we measure it from the top to the bottom, and we can see that Apple broke 75 and continued to fall down into 618, why did it get so weak? Where was all the active investors who would happily buy the dip on this thing and run it back up? They weren't there. Does that mean we can't go long? No, but it would make me more cautious because they should have bought the dip here and they didn't. Heck, they should have bought the dip when it was up here testing the 50 and they didn't. So we get warnings and we get insight because we can see that we didn't get supported where we should have. But we are still above the mid. So it's not an unhealthy company. If it's above the mid, it's still considered healthy to me. And we're still above the 200 period, but the 200's kind of flattened out. It's got a little curve, but not very much, right? Like Kansas, we have hills, kind of, but mostly it's just really flat out there. So that's same thing, a little bit of curve, but not much. So this is a big money sink where they're killing time and just going sideways, and we're not really doing anything. There's no momentum. There's no trend. Um, There's no opportunity, and we don't even have guidance for direction because we've pulled back farther than we should, and now we're stuck underneath a really key level. But on the other hand, that gives us a tradable signal because if we cross back above that, we can try to go long from 75 to 100. Now, the textbooks usually come with warnings about how you got to do it their way. You can't do it any other way. And if you do it any other way, well, then you're doing it wrong and it won't work. I read multiple Fibonacci books and they were in disagreement with each other. One author would say you can't do one thing, and then another author would say you have to do it that way or you're doing it wrong. So I got to the point where I said, just forget these authors and all their ways of doing it and not doing it and how I should and could. And I threw it all out the window. I kept what we covered here, but I got rid of the rest. And started experimenting. Do I have to go from the highest high to the lowest low? Really? Can I do something else? And what about the wicks? Maybe I don't want to use the wicks. Maybe I just want to use the bodies, especially if it's one of those more wiki stocks, right? I'm sure you guys have all seen them, big crazy wicks, and you just decide, you know what, I don't want to use that big old crazy wick. Well, great, don't, right? Don't use the wick if you don't want to. So if we don't go from the highest point to the lowest point, what can we measure? We can measure anything. This is a price leg. Of course, so is this. And we got another leg here. Or we can run it the other way and we could say that's a leg and that's a leg and that's a leg. There's these little legs there, right? A leg there. We can draw the whole thing out if we want to. We can measure any of that. When I go to look at price, I'm always trying to ask questions out of price. So if I was looking at this high and this drop that we've experienced, and I'm starting to wonder, could we form some sort of cup and handle and then maybe go to the upside? Could we do that here and get some sort of cup and handle? If we were going to do that, then the distance from this top to that bottom to me becomes really important. And I would want to measure this and maybe focus on the midpoint, the 75%, the 25%, so that I can start asking questions and have a better idea of where we're at now and what I might need to get that move. And if there's any weakness or failure, then it should show up because of those four lines. So why not use the quadrants or the fibs, either one? They'll both work. Why not use them there? Now, I did that with 100 on the bottom, but I promise it doesn't matter. We'll swap it around. Put 100 at the top. One of the key numbers is that midpoint. It's on the quadrants and it's on the Fibonacci. If we're running to the upside and we pull back, this 100 to 786 is a really big deal for continuation. Well, the same thing is true for the other way around. I should have left it where it was up there. If we run up and we pull back and we don't continue, then that range up there, that 786 becomes really important because that's where we would fail and break down. So now take it the same way. If we was going to continue to go lower here, this 786 area becomes really important. Yeah, the 38.2 is like 618. Now me, I use 23 and 786, but it either one is fine, right? However you like to do it, either one is fine. If it stays under 38.2, then in theory, we're building a flag and we could continue lower. You're exactly right. So your box would be this big and my box would just be that big. But it's the same rule, right? Just a different line in the sand, but same logic. And that makes either one legitimate. In fact, depending on what you trade, the 38.2 would probably be the better choice, right? The reason that the number doesn't matter is well, let me say it another way. Don't get hung up on 38.2 and those, because if I flip this drawing over, I'm trying to keep it offset so that we can still read the numbers, but you can see that the 38.2, it is the 618, right? 50, of course, is still 50. 38.2 and 618. And even these two, they're so close together that it doesn't matter, right? So when we say 23.6, we could just as easily be saying 786 every time, vice versa. They're interchangeable. So what we want to focus on instead is what our line in the sand is going to be. No matter which way we draw it, if we're inside of this range, we can go lower, right? If price came down and we did that, we could go lower. We could argue, though, if we're inside of any of this range, it's still the same thing. We just made the range a little bit bigger, right? To me, I like having this narrower range because it forces price to behave. And I'm picky. I really am. I'm picky. I know exactly what I want. And if it gets too sloppy, it adds too much indecision. So when I see price come down, pop up, and then stay in this really tight range, I get really excited because I can see my trade forming here. When I see price come down and form this range, I'm not so excited about it. Now it's a lot sloppier. I don't have the same compression. I have a lot more doubts and confusion about these tops. Everything's just a little less precise. And if it gets sloppy enough, I'll just walk away from the whole thing and just say, forget it. I don't have any trust in it. I don't want it. That doesn't make it right or wrong, good or bad. Everybody's got to come up with this on their own. But for me, I would rather trade that tight range and not that broader range, even in my analysis. Say we're not talking trades at all, we're just talking analysis. I would rather focus on something that stayed within this range and be much more confident in my analysis as opposed to having it stay in that broader range where I would be a lot less confident in my analysis because it's getting sloppy, right? And of course, that is the exact same range for either side, and the logic will work both ways. Um, for the midpoint, it's the same thing too. We know that perfection can screw something up, right? At least I know that because I try to get too perfect and then it screws stuff up. So if I'm watching price come down for the half and I get into that OCD thing where I'm like, nope, you got to touch the half or it doesn't count. And then it misses me by 3 ticks and runs all the way back up without me. I'm like, you dirty dog. I could have had a trade there, but I wanted those 2 ticks and it didn't touch it and I didn't trust it and it ran away without me. So, don't get too hung up on perfection. You too, huh? I thought that was just me. If it gets in that zone and gets close, you have to consider that it's a valid reversal, right? That it doesn't have to actually get there, or that it can come down and it can get under the level and then still come back up because nothing says that it has to stop right there on the line, right? So, uh, this whole thing can be counted as that mid. It's frustrating, isn't it? Man, I don't really give up money on my frustrations, more of I miss a trade or I'll have an alert set and I'll be looking at other things and my alert won't go off to let me know a trade was setting up because it missed me by 1 tick. And then by the time I see it, it's already moved. I missed my trade. I didn't get my chance. It's frustrating. So when you're focused on these levels, don't get so hung up that you think price has to go right there. Near is good, especially when we're just analyzing things and trying to better understand what's price doing. Now we can use these fibs for a lot of things. Destination trading, targets, areas for confluence. If I draw my fibs or my quadrants and they line up with things like a moving average or yesterday's high or yesterday's low, then I have more confidence in that number that I drew, right? On the intraday, a lot of times my lines will line up with VWAP or they'll line up with a Globex high or a Globex low. And I always love that 'cause it just gives me a little more confidence that it's doing what I thought it was going to do. Oh, please don't tell me my lines are gone. No, I draw them all over again. Maybe they're around here somewhere. Now I've made my lines so many times over the years that I guess it won't matter if I got to do it again. I should have put them over on like the MES or something. Well, I used the reset button so that I wouldn't have to draw the lines and then change the colors. I just reset them back to 0. Um, I did make this little color graph a while back so that if you wanted to make your own. By the way, you can talk to AI and tell the AI that you're using RGB values, and you can ask it to give you various shades of whatever color you want. So if you want like a hot pink or Barbie pink or yeah, you know what I mean, like psychedelic purple, whatever, you can just talk to AI and ask it for the RGB values. On Thinkorswim, go in and code the levels that we want. I want a 111. and a 1, 2, 3, 6. All right, so we got half. We got 1, 7, 8, 6. I think we got them all. Just hit reset here, open it back up. That way it reorganizes itself. And then some colors. If you find that the lines are too distracting, say they're too aggressive and they cover up your candles, or they're hiding something on the chart, Thinkorswim has transparent lines. You can make them almost invisible, which means you can kind of hide them. When you're in the RGB area here where you can go to these different ones, HSV and HSL both have transparency. 0 means no transparency. So if you set it at 50%, it'll change that to where it's kind of hiding in there a little bit. I want to go with this one. Hmm, I don't remember. I guess we'll just use that for now. It'll come to me later. You got a lot of choices on Thinkorswim, and this one is the one that I use for my halfback a lot. That way I don't have to adapt my Fibonacci levels all the time. So set the color for all on this. Doesn't really matter, but I'll choose white. The mid is what I really want to get my attention. And now I make the edges mostly transparent. And if you want to, just make that middle one pop a little bit. The same thing works for that red line that's going across there. You know what I'm talking about? This line right here. I don't like that line. So go back in there and make that line invisible. And of course, I like expansion. There we go. So I use this all the time when I'm trying to find the mid. I use it on one single candle for reversals, like today when we kept flipping over. We had this big bar do that pin bar off the low. Snap that. What I was looking for was if the next candle was going to fall back down, I didn't want it to cross below that level. When we started to run up, you could put it on the last red bar so that you could see, when we crossed the 50% of that bar. I use this drawing all over the place. All day, every day, I'm using this drawing. It's just the half, right? I made an indicator to do that, but then it was really loud. It was all over the chart, all over every single candle, and I hated it. And I quit using it. So now I just use this and I snap it where I want, and then it's fine, right? So I like that.
So just to be clear, you use the quadrant for like shorter moves than using your fibs to for longer range moves.
I use the quadrant just to show me half, and I'll draw that anywhere. I use it on the daily, the weekly, the hourly, the everywhere. So if I want yesterday's mid more often than not, I'll use the quadrant because it really you can really only see the mid. The others are there, but I hid them, right? Because I just want that mid. But that mid, I can do it with the fib. It has all the other lines, and now it's a lot more noisy. And if I just want that mid, I'd rather use my quadrant line. Right? That's why I made it the way I made it, so that the line that really stands out is that middle line, because that's really all I want. Right? For a while, I hid the the one and the zero, and I only had the mid, but that was kind of driving me crazy. So I learned about myself a little bit that I don't want to make them completely invisible. I just want to make them invisible enough or transparent enough that I can barely see them, but I can still see them. Yeah, I already did that one. I should have done the other one. So it doesn't matter. You can use the quadrant, you could use the Fibonacci's. It doesn't matter as long as you can see where the mid is, right? Because that's all I was using it for, just to make it a little cleaner. Because if you think about it, say I wanted to do this reversal on the low here, like we were just talking about. If I do it with my Fibonacci's, now I get all of these lines. And it's okay. It doesn't hurt anything, but I just needed that midpoint. It'd be a lot easier if I just had a drawing tool that just had that midpoint so that the rest of it isn't so messy. But if I want yesterday's mid, I'll do the same thing. Or if I want Globex mid, I'll do the same thing. For a while, I was using the extensions because you can do the same thing with the extensions, but it's a three-step process, right? So you come down here and then you go back up here. Well, I mean, it's the same thing. You can see I've I still have them set up that way because there's the mid, but yeah, either way, just so you don't have to keep going in and messing with your own lines and then accidentally do what I did, delete your lines or delete your settings, and then you lose everything and you have to go set it up all over again because that sucks. So that's how the lines are used straight out of the books. Um, I've adapted it to the idea that we can measure anything we want. Like I had mentioned earlier, this leg could be measured, that leg, that leg, that leg. We could measure each one of those individually if we wanted to. But we can also just measure one single candle, like the 5 minute open bar, yesterday's candle, last week's candle. There's nothing that we can't measure with these quadrant lines and Fibonacci lines. At that point, it just comes down to what are you trying to figure out? For me, a lot of times when I'm snapping these lines, I want to know where the mid is. Or if I think we're going to get a breakout, then I want to know where the possible reversal is. So the textbooks talk about these reversals from their levels, and I don't like their levels, so I'm going to just talk about it from my levels. For me, how I use these is once I've defined the range of something, that'll be 100 to 0. Whatever I'm measuring is within that zone. If we start a pullback, 786 is the line in the sand. If we break that, we're going to half. But more often than not, what I expect is that we'll pull back, we'll test the 786, and if the trend is intact, we'll come back up, break 100, and then it's game on to the upside. Reversals, if it's a fake breakout, reversals happen a lot on that 111. I don't know why, but if a breakout is fake, a lot of times it's going to stall on that 111 and it's going to come right back in again. So I really like having that on there as a way to check to see if it's a potential fake breakout. The bigger the range, the more value that has. So if I'm measuring yesterday's high and yesterday's low, the distance between 100 and 111 is usually pretty wide, 10 points, 12 points. It's a really good zone. But if I'm measuring a 5-minute candle, then the distance between 111 and 100, maybe it's 6 ticks or 5 ticks. Well, that's not really helpful, right? There's not much room there to work with. So just kind of pointing that out there. But if the market is going to continue to the upside, where's the next pause point? The textbooks say measure from this high to this low, and then from the pullback zone, we can apply that same level, and that would tell us the next pause point. And sure, that works for those big sell days like we had Thursday. That works really well. But it doesn't work if we're not having those big crazy sell swings, right? So if we take this and we do what the textbooks say, if this next leg goes farther than this leg went, then the trend is actually picking up speed. So we can take that and put it on the pullback level and ask, where's the next pause point? It should pause right around in there. And that's what we ended up doing. So then when we pull back the next time, we can say the same thing. Where's the next pause point? It should pause right there. Yeah, I know, right? Every time I do that, it's so awesome. But that only works when we have a lot of aggressive trading going on, right? That measurement doesn't fit in a normal trend movement. You know what I mean? Like our day-to-day moves, that doesn't work. So if we're getting extreme, that's perfect. But if we're not extreme, that don't do it. Also, notice how we overshot it down here? That was a warning. Like capitulation. If we had done it across the highs, we would call it a blow off top. But down here, it's capitulation. It went just the little extra, and it was the last hurrah of the Bears. And then we started to turn things around and go back the other way. So you want to pay attention when you're running a really decent measured move and everything is going good, and then something like that happens. It doesn't mean to go the other direction, like don't just jump into a trade and be like, okay, we're going long. Nope. It's just a warning like, hey, things are changing. And sure enough, that was the end of it. It took a while to digest that little bit, but it gave us warnings that, hey, this is things are changing here. This is running out of steam or becoming a risk of ending, and it ended. So since we know that this example of measurement doesn't work in a normal trending environment, say in an environment like this where everything is more compressed, then we need something that is measuring smaller bites of the apple. And that's where my drawings come in using that 111 and the 1236. So what I'll use it for is if we got price in there and it's at a spot where I'm ready to measure, I measure it. We got a little bit of a pullback. I snap my lines and I now know where the next pause should be. I call that the OCC, opposite candle color. Now, I said that to someone today and their first response was, "Oh, so we're going to go the other way?" No, 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 no. We're just looking for the candle to change color. In this scenario, since we're talking about up, we would be looking for a red candle. But it's not really just OCC. The whole sentence is we're looking for an opposite candle color or a doji. We're looking for price to get up there and pause, just like it did here. And if it does do that, then what I like to do once we get the OCC or the doji is I move my drawing up, and now we got a new level. And we got a new 1236. We got a new 786 for the weakness. And we got a potential liquidity zone at that 111. Because if the next breakout higher is fake and it fails and we start to fall, it's going to happen on that liquidity zone more often than not, right? If the breakout fails, it almost always seems to fail at the 111. So then if we make the next move up, we get OCC up there. And if we do, I wait for that candle to close and then I move the drawing up to the next level. And I'll keep doing that until we finally stall, flip, and reverse. So that helps us define each pullback so that every step along the way, we know where the next pullback is and the next pause point, on and on and on. Yeah, no, anytime, anytime, interrupt anytime.
Can you hear me say that?
Yeah, yeah.
Okay. On that topic, what you were just doing, I wanted to ask. So I know in the morning when you're doing your morning prep and what have you, you are going through and marking generally the prior days, high and low with the candle or with the fibs, and you're using that in the morning. How long are you approximately using that for? Like the first hour, those levels, or are you changing it after the first 30 minutes? Going with the new day's levels from the range of the new day. I want to get some clarification on that so I can understand.
Sure, no, that's a really good question. Let me put yesterday's on, and we'll talk about it from the perspective of the pre-market, like would normally do in the morning briefing. Since I need all of yesterday's high and low, I'll just come out to the daily and snap it, and then I don't have to squint or fight the little lines and the little wicks, and we just snap it on there. And so there's my levels, right? Now, when are those levels going to be valid today? They're only going to be valid today if we get to the edge of yesterday's range. If we don't get to the edge of yesterday's range, then I can leave them on there all day, but they won't have any value because we're not there, right? So I can snap them and leave them there. And the only lines that I need is the mid and the 111 and 1236 on each side. Those are valid all day long, because look at what we have. Yesterday's low, yesterday's high. Those are good all day. The midpoint of yesterday, which is also good all day, even if we cross it 50 times, we still want to know, are we above the mid of yesterday or below the mid of yesterday? And then we have opportunity only if we actually get outside of yesterday's range. Now, I like a clean chart. So while I could leave it there all day, a lot of times I will take my drawing tool and I'll mark the mid, even if it's just a small line that only I know what it is. I'll mark that mid and I'll delete the rest if we're nowhere near the edge, just because I don't want that big drawing all over everything. And if we're nowhere near the edges, then I don't need the high and the low, and I don't need the expansion levels. I just need that midpoint. And as long as I know where it is, then I'm good. If I stare at it long enough and I know that that's 65, 69, 65, at some point in the day, I just delete it. I don't even have it there anymore, but I know where it is. It's 69, 65. So I'm good. I don't even need that line, but it's still good all day. What I'll focus on instead is, where's my Globex lines? Same thing. I've got my midpoint of the Globex and I've got my high and low of the Globex, but they're only really going to be valuable to me, these 111 and 1236, only if we actually get the breakout. If we don't get that breakout, then there's just no value. You can keep them on there anyways, but they're kind of loud and noisy. And if we're not breaking out, what good are they going to do us? I should have saved those as default and I didn't. So there we go. Now I can quit drawing them every time. So they are valid all day. But if I now was to snap my intraday fibs with these Globex fibs and these fibs, boy, it's getting messy, right? You start to see my dilemma. So 65 is the mid. Well, in this case, it's 64. 64 is yesterday's mid. I can take that off, just put it in my notes. 64 is the mid. And then for the Globex, that's VWAP. VWAP is the mid of the Globex. Okay, well, I don't need that one anymore. I can delete that one. And now the only one I have actually showing on my charts is perhaps today's mid. But make no mistake, if we get near the edge of the previous day's high or the previous day's low, then I absolutely will resnap those drawings and put them on there, because I'm going to want to know where they're at. Then what if we do get a breakout? We'll just go back to a day where we had a breakout and then we came back in again. We've had some good examples of this, because at some point in the day, once we've used yesterday's and we've perhaps come back in again, or we went beyond it, then I stop using them and I do focus on today's. So here's an example where we had the previous day's high and the previous day's low. And in fact, we got two. We have the RTH, and then we have all of yesterday. We can use either one. Why would I want one versus the other? Well, it's how far this distance is between 111 and 100 and between 1236 and 100. If I use a smaller measure, then these distances are smaller as well. So say you're going to leave the house and you're going to be looking at this on your mobile and you just want one line, then do the whole thing. And that way you don't have to mess with it again, right? That is the real valid the whole gosh darn kit and caboodle. But if you have the time and you're at the computer and you're nimble, then you could say, well, I'm going to start with the smaller range. And if we break through that and we continue to expand, then I'll put on the bigger range. The difference between these two today really isn't all that big in this example. I think it looks like 2 points difference, but sometimes the difference can be pretty big. You would just want to start with the smaller one because you're going to hit those smaller lines sooner than you're going to hit those bigger lines. But either way, once we've hit it and we've rejected off of it and we come back in, unless we go back out there again, I don't need it anymore. It's already proven that we're done with it, and I'll get rid of them and start focusing on RTH candles. But the key is I need RTH candles. 5 minutes is not enough. In the way that I've done things, I have determined that I need at least 30 minutes. 30 minutes of a 5-minute candle, I find is good enough. So once 30 minutes has gone by on a 5-minute chart, I'm willing to snap an intraday set of fibs. They can take precedent over anything that I had in the Globex or anything from yesterday, especially if I'm nowhere near the edge, like yesterday's high or low, or if I'm nowhere near the mid of yesterday or the mid of Globex. If I need something more immediate, then I'll have my intraday fibs. But at the end of the day, it all comes down to what are you going to hit first? If you're so far away from the edges that there's no chance in hell that you're going to hit yesterday's levels, then you can leave them on there, sure, but they're not your immediate concern anymore. More immediately, you're going to hit your Globex levels or you're going to hit your RTH levels of today, and they're going to be more valuable to you. You can see we didn't get to the Globex edge until after lunch today. So while the mid was perhaps valuable because it was the low of the regular trading session until almost 11 o'clock, we would have wanted to use the fib levels on the intraday because they were going to be providing more value. And sure enough, when we did get a breakout, that's exactly where we went to, is the 1 2 3 6. And then we got the OCC, so we would have wanted to expand at that point. That's not what I was trying to do. Dirty thing. So then on our run back up, we hit the mid, just like we would expect. And then we overshot. So there's our blow off top or our capitulation low, which tells us it's likely going to be a reversal again instead of a continuation. But we would still move the drawing. Now we had the highest point of the day to the lowest point of the day, ran back up, checked the mid again, which happened to also be VWAP, and it happened to also be the mid of yesterday. Down we go into the next 1 2 3 6 pin bar reversal on the 111. So it works itself out. To me, looking at this chart right now with all of this, it's really loud. It's really messy. And when I'm trading, I don't want that much mess. I got a little notepad sitting on the desk. I will oftentimes just write a level down, or I'll put it in the notes here on the scratch pad because that's really handy to use. Throw it in there, and that way I can just reference it without having all these lines all over the place.
Thanks, Sigmund. Yeah, I just want to clarify. So basically, that generally, if it's not reaching a destination, within like the first 30 minutes, that's what I've been doing. I just been getting rid of it. Of course, depends on if the Globex is higher than yesterday or whatever.
Sure.
And then what I'll do is I'll snap something at the 30-minute mark is what I've been doing, using that whole 30-minute period. I just wanted to clarify, and then I know you've mentioned, you're looking for it to come in, or even before it breaks out. A lot of times you're talking about it goes to the 78.6, something like that. Anyways,
Yep.
for the pullback, play. So that's kind of what I wanted to validate. So I do have some clarification on that. That's kind of what I was thinking.
Yep, you nailed it. That's exactly right. If it's not helping you, just get it out of the way. But be willing to put it back on if we're gonna get that breakout, right? Because it could happen at 3 o'clock in the afternoon. If we go to yesterday's high or yesterday's low at 3 in the afternoon, I will have those lines ready to see if we get that breakout, what are we going to get down there? And to me, they'll be just as valuable as the intraday lines that I might be measuring at the time while we're running down there. I've had that happen to where, just like right here, the lines start to overlap each other. I'll still have yesterday's levels because I'm still looking for that breakout if or when we finally get it. There's no wrong way to go, right? Because all these lines are giving us is possible turning points. And if your intraday lines from today overlap the same lines as yesterday, well, then it's just confluence, giving us more confidence that the particular level is likely to be an area to get heavier trading. It could stall price, turn price around, could be the place where we finally stop moving and digest for a while. It's just a spot that says pay particular attention to this spot in the chart, and or it's a destination so that when we go to the next level, where are we going? To that level, that next spot. But if we do get there, say in the Globex, we get down into 111 and 1236, and then we pull back in, I'm done. I don't use those anymore. Once we get 30 minutes into today, I will turn those off. Even if we revisit the low later that day, I will focus on what we've built in the Globex that got us down there and what we've built in today's session, and I will not turn those back on from yesterday because we used them already. We're done with yesterday at that point. Something that really helps with all of that too is to get examples. It's one of the reasons that I've always recommended people open their own Discord. It's free, it doesn't cost you anything, and you can take a whole bunch of pictures, say like these 111s, and you can put them all in a channel that talks about, say, Globex 111s and yesterday's 111s and yesterday's 1236s. So in this example, I put the date on it, and we can see that we were using yesterday's RTH high and low, and we had an interaction with the midpoint. We expanded to the downside, and the pin bar reversal got us down into the 111, and then, really nice turnaround, target right back up to the mid. When you get enough of these, you start saving them, collecting them, adding them up, and then examining them, looking at them in detail, how price responded at those levels, what time of day it got there, what yesterday looked like. You see it often enough that you know what the trade looks like because it's the same thing over and over and over and over again. If it begins to misbehave, it'll look like something you haven't seen before. Then you don't need to worry about the stop. You can just look at it and say, hey, you're not supposed to do that. I've never seen you do that before. I'm getting the hell out of this trade. I don't want to wait around to see what happens next. You're misbehaving. I'm out of here. You just get out of the trade. Here's yesterday's high, yesterday's low. Break down to the 111. Run back up, failed to get to the 786 and did it again down to the 111. Finally got through the 786, but we wasn't able to keep it. Down again with a really nice 2-bar reversal on the breakthrough, kind of a capitulation low sort of thing, and then flipped around back to the 786 again. Actually got through it that time and made it to the mid.
So, Signet, are you trying to play on something like that previous, what you were just showing? Are you trying to play back to the 50%, or are you looking to see what it does at the 78.6? And if it kind of reverses and starts going back down again, are you going to go on ahead and short it, in other words, at that point?
I'm not looking to take every single trade all day long. So the answer is no, I'm not. But you could. If you didn't get the low and run it up, then why not get the high and run it down? Right? But me, I don't want to get in to go up and then out and then go down, and then go up and then go down, and then go up and then go down and get 40 trades today. I am not interested in doing that. But you could.
Okay. So you're mainly looking for just the run back to the 50% retracement then?
I'm looking for the highest conviction trade that I can find today. The one that shows up that has the highest conviction, that's the one I'm going to take. And once I'm done, I'm done. If I find something else that's even sweeter than the one that I already took, I might take it. I might, especially it depends on what time of day it is. But once I'm done, I'm done. I don't need 10 trades. I don't need 5 trades. Most of the time I take 1 or 2 and that's it. So whichever one tickles my fancy enough that I pull the trigger on it, if it works out and I get my target profit and I'm satisfied with what I got, then I'm good. Whichever one happens to get me there first. So if I didn't like the first reversal, or I was getting coffee, or I missed it, was talking to the cat, whatever, I missed the first one, I'll try the second one. Run it from the high to the low, or run it from the low to the high. And each one is level by level by level. So once I got in at 111, my first target is 1. If we get past 1 and we're still going, I'll go for 786. If we get past 786, I'll go for half. But when I get in all the way down here, my target is not half. My target is not the top. My target is the next level. Fibonacci trading 101. The only level that is in your focus is the next one in line. These other levels aren't valid because you haven't unlocked them yet. Now, that's something that I get from traders all the time, especially when they just start getting into this. Take yesterday for an example. I was talking with somebody. We were at the lows down here. We was looking for that reversal, and I said, "Okay, get above 786, we can go for the half." The first thing somebody asked me was, "Hey, do you think we can go back to high a day?" I don't know. I don't care. I'm not even focused on that. Right now, we got through 786, and the next thing we want to focus on is VWAP or the half. They were the same thing yesterday afternoon. But that was the only focus. The only focus is where's the next level, because that's the only level I'm focused on. I don't care if we get back to the high end and we can get out of that and we can go even higher. I'm not even trying to gauge or ascertain that. I'm just trying to get to the next level. I don't like 50-point trades, by the way. Back in the day, I used to love them just so that I could take pictures of it and throw it in the chat and be like, yeah, bitches, check that out. 50 pointers. Rah! Flex a little bit. But it sucks. You wait around all day long trying to get this 50-point move, and then you take it with maybe 2 contracts, right? Because you don't want to go big if you're going to be holding on to it for 4 hours and managing these really big pullbacks. For what? Right? For all the stress and the anguish. I can't go anywhere, can't get on the phone, don't go outside with the dog, don't do anything because you got 2 contracts in and you're stuck staring at the computer for 4 hours. Thanks, but no thanks. I'd rather get a 7-point trade with 10 to 12, 15 contracts and be out and done in less than 10 minutes, and I'll go do something else for the rest of the day. Or I'll get 3 of those or 5 of those, and I'm still happy. And I don't get the gray hair and the anxiety and the stress, and I'm not stuck at my computer for 4 hours waiting for it to make that move. Let's focus on yesterday for a moment with this reversal. Wouldn't it be awesome? Take that all the way back up. We knew the reversal was solid. We knew the 786 was done. It was on the run. Wouldn't that be great? Take the whole darn trade. It's a 100-point move. Who doesn't want a 100-point move? Not me. You see the size of this pullback? How many of you was actually going to be willing to hold that pullback? Now, I'll make the lawyer's argument for you. Well, you already made this much money. Aren't you willing to risk that much after you've already made this much? No, I'm not. Are you? Then fine, do that. But I'm not. And I'll continue the lawyer's argument. But our target is all the way back up here. You could make 100 points. Surely you're willing to take a 40-point pullback. Nope. Are you? Then fine, you should do that because I'm not going to. Those are all things that traders struggle with until you finally resolve these. And it's not, my way is not the right way, right? My way is not the wrong way. My way is my way. So when you do resolve these and you're no longer conflicted, oh, you'll be so much happier. If you do like those targets and you want to run 100 pointers from the bottom to the top and you're trying to do that, then do that. Don't think that my way is the only way. But I don't, because I learned along the way that this sucks. I don't want it. I'll do it in options. I'll happily do it in options, but I won't do it in futures. Once you find out what your trade looks like and you're really confident in how it's supposed to work, you'll live life so much happier. Oh yeah, these fib tactics work on everything so far. I've tried it on commodities. I tried it on FX markets. I did it in bonds. So far, I have found that it works everywhere. I'm sure at some point I'm going to find something that it doesn't work on, but I haven't found it yet. Maybe the price action of the option, right? You guys chart your options? I'm not really a big fan of this, but I've seen traders that do it. So say we were going to trade the Monday call, right? This 693 call. And we're going to buy it, right? We're going to buy some calls, run SPY up off of the lows, like that low of yesterday. And so we run in there and we buy a call and then we chart that call, right? Off of the low here. Say we were trying to take that reversal. You guys chart your options? Yeah. Measured move can be anything. But let's start with the ones in the textbooks. So the textbooks will talk about things like uh, head and shoulders, wedges, falling wedges, asymmetric wedges, ranges, anything that can be measured. Here, for an example, is Apple, and this is a head and shoulders, and this is a measured move target. Now, this is a known measured move target. Everybody has agreed with the way we're supposed to do it, and that means we can build indicators that do it the same way every time. And when people look at it, they agree that, yep, that's definitely the way you do it. Now we can add stopping points along the way. I like to use 50% instead of the entire 100% move like this drawing did here. But that's a valid, well-known measured move and a perfect example of what a measured move is. So the idea is that everything out there has a known measured move. This is the one that we use for head and shoulders, and it's the same tactic that we would use for a range or a falling wedge. Let's try a different product. I think Google has what we're looking for. Yeah, double top. There we go. We'll take it. So this is a double top measured move, and every one of the patterns out there has this tactic to it. It's the trader's responsibility to learn where the starting point is for all of these different tactics, right? Like the head and shoulders uses the right side of the upper shoulder edge. For the double top, it's the breakdown point. Um, for the cup and handle, it's the cup, right? Like every one of them has a different starting point for the measurement. And so you just you read a couple of candle books or watch some videos and you pick specific candle patterns to learn about where the start of the measured move is and then what we're supposed to measure. it can get fun, like Amazon here. We've got multiple patterns laying on top of each other. We've got the head and shoulders and an asymmetric triangle, and then there's like a double top in there. This indicator is called, I believe it's this one, all chart patterns. You would just search for that, all chart patterns. If I turn it off, yep, that's the one. It is kind of handy. I like it because when I'm jumping through a lot of charts, I kind of want to go through a little fast. Like I don't want to spend too much time. So when you put that on there and you use your space bar on TradingView, you can go through your watch list kind of fast, right? Because the space bar is the you telling it go to the next chart. So I can just sit here and space bar, space bar, space bar, right? And I can just keep flipping along really quick. So a good way of doing business, right? But um, to me, they're not trades. They're just giving me an idea of where we're at and where the destination is. And then I can decide for myself if we're close enough to it or we're still far enough away. Maybe there's an opportunity. Maybe I'll go find a trade somewhere in there. If you like that one, check out Elliott Wave. Now, Elliott Wave's a bit controversial. I know Elliott Wave traders, and I am not an Elliott Wave trader, but I do like the idea of having a narrative for whatever market you want to trade, right? The narrative is explaining how we got to where we're at. And I think a really good example of a narrative is looking at the market app, right? So if you go to the market app and you pick a stock, I've got US dollar Japan up here, but you can see all of these written things that are on here. So it explains this narrative and helps us understand how we got to where we're at, right? Like, oh yeah, this consolidation was because of that news. This breakout was because of this news, and that's the narrative, right? Well, while this is really awesome, we don't have that on a lot of stocks. At least I don't have it on a lot of stocks. So I like having a narrative to help me better understand how did we get to that particular place on the chart? What kind of news helped drive us there? And the Elliott wave can offer you that sort of a narrative. I don't have it loaded, so just go in and type in Elliott. You can see Elliott wave chart pattern. Load that up. While you can use it on the intraday, I don't recommend it. So here's Elliott wave on the daily. And then, of course, you can apply it on the weekly or the monthly or whatever suits you. I wouldn't use it on too small of a time frame, but of course you can. And if you go too big, it'll just start to get out of control. Just keep in mind, this is not a prediction software. It's not telling you we're going to go to these levels, but it is giving you targets or destinations. Just like we've been talking with fibs, if we was to begin breaking down, then we could continue to stay short as we get to level by level by level using other means and other measurements, keeping these bigger picture lines in the sand. Elliott wave. I'm not an Elliott wave trader by any means. And if you listen to someone who's an Elliott wave analyst, they do a really good job of describing how we got to where we're at, which is why I call it a narrative indicator. They'll talk about the first wave and the second wave and all the little ABCs that you can see inside of this. they'll go through it in great detail and explaining it. It's awesome, but it doesn't help when it comes to, all right, so what are we going to do with this thing, right? Like when it comes to this point, we're going to buy it or sell it here. Those Elliott wave guys won't have anything to say at that point. They're like, oh, I don't know. Yeah, thanks.
So there was something you mentioned. I don't know, it was this morning, but I know that you were talking about even a little bit ago where you were using the bar thing. That there's like a kind of like a 3-pattern move or something like that. You can get 3, you can get 5, you get 7, where something will move up, you expect it to pull back. So that's the first, and then you can get the second move and the third. I think I even heard Jeremy talk about this at one point. That'd be a great discussion, maybe for next class or something like that. Does that make sense what I'm saying?
I know
It's
what
on a move up and move down.
Yeah, I know what you're talking about. It doesn't suit my style. I have mentioned a 5-bar rule before. That's about as far as it gets with candle counting with me. That I'll look at a 5-bar rule, which is really simple. We don't even need to save it for another day. The 5-bar just says, hey, we've had 5 of one color. It's time for another color. And that doesn't mean we're going to get it, but statistically, we're much more likely to change colors after the 5th bar than it is for us to get 6, 7, 8, 9, 10, 15 of the same bar without yet having changed colors. But statistics and odds are kind of funny about this. It's the quarter logic. For anybody who's traded options before, you might have heard this. If I flip a quarter and it's heads this time, what's the odds that when I flip the quarter, it's going to be heads next time? If you already have done this in the options world, don't cheat and blow it for everybody else, right? Don't ruin the answer. If we flip the quarter and it's heads this time, what's my odds that it'll be heads next time? Well, let's suppose it is heads. Now I've got heads twice, and I'm going to flip the quarter. What's the odds it's going to be heads again next time? Anybody want to guess the answer to that? So now I've flipped it and I've got heads 3 times in a row. What's the odds that if I flip it, that it's going to be heads again for the 4th time? What do you think? 30-70, 60-20, 60-40, right? 80-20. What's the odds that it'll be heads yet again? It's 50-50. It will always be 50-50. Even if you get 15 heads in a row and you go to flip it for number 16, what's the odds that you get heads versus tails? 50-50 shot. Because every time you flip the quarter, it's a 50-50 shot. It doesn't matter what you had before. Now, why do I bring that up when we're talking about counting candles of the same color? There is a school of logic that says after 5 bars, you should start to see a color change, and the odds of you getting a color change go up for every new bar past 5. The other analysts will use the quarter argument and saying that's not true. You have a 50-50 chance that the color is going to stay the same versus the color changing because every bar is a binary choice or a binary chance of being red or green. And that is always going to be true. Even if you had 30 bars, all the same color, the next bar is still a 50-50 chance that it's going to be the same color or an opposite color. So with that logic, knowing that logic as a statistician, I don't put a lot of weight into the bar counting and all of that. So I do mention the 5-bar rule because I know it's popular and people like it, but other than a little bit of an anomaly, I don't put much stock in it myself. 1, 2, 3, 4. We didn't even get to the 5th bar, right? We flipped. 1, 2, 3, 4. We didn't even get to the 5th bar. We flipped, right? 1, 2, 3, 4, 5. We flipped. Now, did I cherry pick it? No, not really. I just looked at what I had there on the screen. But you know what I mean? Like, I just don't put a lot of value in it. I certainly won't use it in my analysis for the day. I won't use it as targets or levels or trades or triggers or anything like that. It's just a little bit of an anomaly where I will often point out and say, oh, look, we got 5 of the same kind. Now you can get indicators that count narrow range. You got NR3s, NR5s, NR9s. Those are narrow range bars. It's basically counting how many bars you have inside of one single bar, like an inside day times 3, times 5, times 9. But they're not called inside bars. They're called narrow range bars, and the designation is NR. So narrow range, and then whatever your digit is. And there's indicators for that one. I don't use NR bars. I just call them inside days or IX10 bars.
Saying that, I think what I was trying to ask or speak to is that generally once you get the first move, a lot of times you'll get the second move on the pullback. That is kind of what I was talking about. Because I heard Jeremy mention this, and I think Marzides mentioned this too in the past. Like you'll get a move, like if you're looking at lower time frames, like a 5 minute or whatever, you start getting that breakout. A lot of times it'll pull back, and then you'll get the next move up, or down, whatever, which direction. Does that make sense? What I'm asking or saying?
I would say you'll want to take that to them because I don't use it in my logic. Mm-mm.
Okay.
Yeah. The I don't have anything that I use in my trading that comes remotely close to that. The closest thing that I have, when the candle's still alive, yes, I'm trying to think of what I would use that fits that scenario, and I don't have anything like that. When the candle's alive, I'm not counting any swings inside of it. You'll definitely want to take that to Marziti or Jeremy. One thing that I've been trying to put together, and I've got enough material that I think I'm going to start doing some education on it, is knowing what your trade looks like. This is something that if I can articulate it well enough for people to grasp the logic of it, you can take it as a new tool and you can apply it all over the place. I often see traders struggle with, should I get in here? Is this where my trade should start? Where's my entry? Do I wait? Oh, it's a bad entry. I should have waited another 10 seconds. All these different what ifs and maybes, and I don't know. It got to the line. Do I let it close and then get in? Do I get in before it closes? All these different scenarios of what ifs and maybes, and I'm not sure's. And when I ask them, what does your trade look like? Can you just get out a pen and paper and draw the setup? What does it look like? Most of them aren't able to do that. So I got to ask for anybody, when you go to take a trade, what are you trading if you don't know what your trade is supposed to look like? Now I know what my trades look like. I've got many of them. So it's like relatives, right? They all don't look like Uncle Bob. They each look different. They have their own uniqueness to them. And I could draw every one of them out. I've drawn two that are in the chat, and one of them I made automated once just to see if I could, because while I've made stickers and emojis before, I had never made one that was actually alive like a video, and I made this one. This is one of my favorite reversals. Now that reversal could be off of the 111, the 1236, the mid, the 5 minute open range. It doesn't really matter. It's just a reversal pattern. But I love this setup. And it doesn't always look just so perfect like that, right? Sometimes there's a couple of extra bars along the bottom, whatever. But I know that trade, right? That's one of my favorite trades. It's my baby. I'll recognize that thing anywhere. So what does your trade look like? This is a TRB. You would think it's the same as this other one, but it's not. They're different, and they have different rules, and they show up at different places. I treat them differently, but if you don't know what your trade looks like, what are you trying to trade? Like, how do you know that the trade is working? What it happens is you end up having to use a stop because you don't know when the trade is beginning to fail you. You just know that you don't want to lose more than X amount of money. Me, I know what my trade looks like. If it begins to misbehave, I know because I'll look at it and say, "Hey, you're not doing what you're supposed to do. You're you're not supposed to do that." And I just get the hell out, right? Like I don't wait around. I'm not going to let it go hit my stop. I just leave because it's not doing what it's supposed to do. So if you don't know what your trade looks like, then you should spend time trying to figure that out. The best way to do that is to go look in the past and ask questions like, if I could choose to trade any of this price, I just put a couple of days on here, 90 days. I can scroll back and I can zoom in so that I can see what's going on a little bit. You know, not too much, but zoom in enough you can see what's going on. What do you see that you would like to trade? Right? And that's where it would start. Like, well, I got this range here. It's kind of tight. I'm not really interested in trading that range itself. But if price was to break out of that range, well, I'd really like to get a trade on that. Maybe a nice expansion. Great. How do we recognize this in the future so that the next time it starts to behave like this, we're ready to take a trade and we know what we're looking for and we could evaluate where the entry might be, right? Like you want to go find your trade out there and then find as many examples of that trade as you can find. This is one, and it's not even a good one. I just grabbed it like, well, there you go. But we can find a price pattern that we like, a setup that we like, some signal on the chart, and we could say, I really like that. Well, I like that. I want to trade that. Great. What are the key ingredients to be able to find that again in the future early enough to get the trade and not miss the darn thing, right? We need to be able to spot it soon enough that we get a chance to trade the darn thing. So I'm really comfortable with where my trade is, where it's supposed to be and where it's not supposed to be. And if it doesn't look the way it's supposed to look, a lot of times I just won't get in. Or if I did get in because it started out well and then it begins to misbehave, I just get the heck out again. This is a 111 reversal and it did not have a really good reversal pattern signal here. The first opportunity that we would know that it's an acceptable entry, unless we wanted to get aggressive, would be after it broke the midpoint of that red bar. And that's a real aggressive entry because you don't have any real pattern or signal or setup at that point. All you've got is, well, it crossed the mid, so I guess I could jump into it. Right? But is it tradable? Yes, but it's an aggressive one. What I would need, because I know this setup, I would need for it to close above the 50 and the new bar to open and then to continue that drive. If it touched the half, I would get in. But if it got below the half, I would not. Even if it got below the half and then rallied back up, I still would not. Right? Because I know me and I know my trade. I know what there's all of them are supposed to look like. And I try to grow this out, right? Like every day I'm growing as a trader, I'm growing as a person, and I try to add new trades to the system. But it takes time because I have to figure out, is it something I like? Is it something that shows up often enough that I'm willing to learn how to trade it, to spot it? What kind of success rate does it have? So there's a lot of work for me before I add a new one to the system. But the outcome is fantastic because when I go to get a trade, I already know that it's my trade. I'm not sure if we were supposed to get snow or not. Alexa, is there any snow in the books for this weekend? Snow free. Thank you.
Going back to your trade, I was looking at the um, ES futures, and there's this one candle that I really like. I call it the trampoline move. Like most times it works, but when it doesn't big time. It was on the I think 1:15 p.m. It's kind of like your TRB, I think it is. It's a trampoline. You see it right down there. Yeah, yeah. That you just passed over it. That yeah, the bullish one. Yeah. And sometimes when I see that, but I guess it has to pull back really, really hard, and then but it didn't work this time. It looked like it was about to work, but what got me nervous was that candle afterwards. It was one of those big ass candles. To be whenever I see that, I get a little nervous.
That hammer candle is a pretty awesome candle, by the way. The hammer and the hangman, they're really awesome candles. I've always encouraged people to learn two continuation patterns and two reversal patterns. The reversals that I chose are things like the evening star reversal, the morning star reversal, and the hammer and the hangman. But you can choose, I mean, there's just so many choices out there. But the hammer and the hangman, they complement each other. One's on one end of the run and one's on the other. And then the morning star and the evening star reversal are also one at the lows and one at the highs. If you was to spend, say, I don't know, 3 weeks focused on blog posts and news articles and videos that talk about hammers and hangmans, you would radically alter your approach to trading because of those two patterns. And the reason that they're so valuable is because they're used on the turning point, just like this hammer that got your attention today. This one hammer can be a part of what we call the drop base rally system. It's also a part of a 3-bar swing low. And if we had a decent enough gap, I could squint at this a little bit and say, yeah, it's kind of a morning star reversal sort of a play. It's not, but I mean, we could say, it's kind of like one. So,
But you know what also is giving itself away too. I've noticed lately that you guys called it out. You and Marziti, that big ass candle right after it. Whenever I see that big A candle, I know that it's trying to shake people out. And then once it does, then it reverses again harder and goes back up. I see a lot of those these days.
Isn't that a liquidity grab? What's considered a liquidity grab at the bottom?
um, I'm I'm not going to call it that because I don't use that language. You're going to want to ask Marziti or Kevin. Um, I don't know
Yeah, I
where
think Kevin
they.
uses that term.
Yeah, I don't want to say that it is and then have him say it's close, but and then, have all these reasons that it's not one. So, not my language type. I would probably steer you in the wrong direction and then I'd get you all screwed up. I'll defer to them. Not my language model. For me, it's a pin bar or a hammer and it's facing the right direction, which is nice because back here we had a hammer earlier today across this high, but hammers don't belong up there, right? Hammers belong down here where we did find the hammer. Plus, it's going the wrong way, right? Like it's just wrong. It's not supposed to be there. The inverted hammer. So, you know, I'll just stay in my lane. For me, a pin bar or if I do use any term with the word liquidity in it, it's usually for the LZ, the liquidity zone, and that is my 111. And even with that, I pretty much erased liquidity zone out of this. All of my notes, I took it out. I don't have that phrase anywhere just because so many people are hung up on these liquidity this and liquidity that and it's a bunch of silliness. I said I don't want any of it. So I took it out of my own notes and I've been slowly weeding it out of my vernacular so I don't even use it.
What is that call right there where you're under your VWAP, that red candle down that bottom next, yeah, that right there. No, going back up, sorry, segment, where the red candle is, go all the way back up and then come back down to the bottom of that one. See that red candle that's flipped up, all the way down the other, come down now. Come all the way to the bottom. No, other way.
This
Other
way.
way. Yep. Yeah, next that candle right there, the one right in the middle. Yeah, that one right there. You were just pointing at it. Yep.
That can be a dragonfly. It can be just a regular doji. It could be the graveyard doji. I would just straight up call it a doji, but
To me, it's signaling exhaustion.
I agree. It certainly looks tired there, but when it comes to dojis, there's like 15 different kind of dojis. So which one is it specifically? Is it the graveyard doji or the dragonfly or the graveyard? I don't. It's a doji. That'd be the safest thing to call it.
It's a dog.
Yeah. The At the end of the day, though, I mean, the doji is a doji, right? If it was a dragonfly, it would have the cross at the top. This one's a gravestone. Gravestone doji is what that one is. But does it really change anything to know that it's the the gravestone rather than the dragonfly, right? Like it's still a doji.
I guess the point
The may
I was trying to get at is how would you know that that's reversing at that point? At those, you'd have to almost wait for the second candle after that. You understand what I'm saying? So you have to kind of wait for that. Like she was just saying
this is the
the next
the
big ass
candle to
candle.
trade. That's the candle to
You
trade.
have to wait for that.
Of course, you're supposed to. The trade isn't the doji, right? Because the doji closes and then you have a doji. Until it closes, you don't have a doji. You just got a candle that's open. Well, okay. So now the doji closed. What do you have? You have price inside of a range. That's all you have. So you can measure the midpoint of the doji because at that point it's just a candle. It doesn't mean anything. It's still a candle. Got to get through the mid. You got to get out of the mid. So until you get out of that range, you got nothing. The doji, after it's closed, helps you understand that we've stalled, that we're likely exhausted, that we could be looking for a reversal. Then you get the next bar, which stays inside of that doji range, helping confirm that we're not going lower. Then we get the next bar and we begin the run back out. The trade doesn't even begin to form until at least this bar, but more my style, the next bar. There is no trade on the doji itself because you have no doji until the doji is closed.
So technically, the trade isn't until after you get over the high of the doji.
For
When
me,
that's technically when you should get in for it. Get into the trade.
for me, for this time, yes. But this is a skinny little doji. If it was a much bigger doji, I'm not sure that I would wait for price to get all the way outside of it before I took a trade. There is no wrong way to trade this, by the way, right? It would just be user preference. At what point do you decide that your trigger is met and that you're going to get a trade? Remember, I know what my trade looks like. I know where I'm getting in. You would have to define for yourself, well, where are you going to get in? And there's no wrong answer. Some Joe Schmo is going to sit out there and say, I'm not getting in until it breaks the top of that. Always and always, forever and ever, amen. Great, then that's the way that they're going to do it. Somebody else might come along and say, nah, we made it through the midpoint. As long as we're through the midpoint of that reversal bar, then we're good. I'm going to get in because we're through the midpoint. Then do that. There's no wrong way to go. By the way, as long as you're right and price goes up, any of those entries work, right? And that's kind of the thing that everybody seems to overlook. Oh, well, where's the right place to get in? I promise you it won't matter because if you're wrong and price goes down, wherever you got in, you're going to lose. Captain Obvious stuff, right? Like, gee, no kidding. You mean if it goes down, my long will lose? Yep. And it won't matter where you got in. So does it matter if I wait for the mid or if I wait for the breakout? Nope, doesn't matter at all. As long as you're not wrong and this is not going to continue to go lower, any of those entries are going to work. I know it sounds really obvious when we lay it out that way, but that's just the truth of it. It won't matter.
But that's kind of like you were saying earlier. Tend to be over analytical on some stuff, and that's my personality type, though. I tend to overanalyze something before I get in it, which then a lot of times I'm getting into a very. I've learned to stop taking trades late because I end up just getting reversed on. So I try to get in at what I think is the appropriate time and stop overanalyzing.
As long as it suits you to where you can hold, how do I say this in a way that makes sense? When I'm not happy with a trade that I get in, inevitably I get out. And it could have been the best freaking trade of the day, but if I don't like something, say I feel like I'm late or I feel like I'm early or anything, if I don't like the if I don't like the trade, even if it's winning, I get out. Why? I wish I had a better answer. I don't know. But if I don't like it, I get out. And that sucks because I've gotten out of some really good trades that if I'd have just stayed in it, it would have been a fantastic trade. And I got out because I didn't like it. So if you like it, that's what matters, right? Because if you don't like it, you're going to screw it up and you're going to get out and then you're going to hate it because you got out. Like, why the hell did I get out? I don't, I struggle with that. I really do. I struggle with it because I know what I'm looking for and I will take the trade when I see it. But if I get in a little too late or I'm in a little too early or it does something that I don't like and I get out and then I look at it 5 minutes later and I start cussing at it, calling it dirty names because why did I get out? I should have just stayed in. And damn it, it would have worked. It was fine. There was nothing wrong with it. So you got to like it, right? That can get a little tricky when you don't quite know yet what you like. And so you got to experiment and kind of try different things to see how it fits, which is one really good argument for trading on paper so that you can, experiment and try different things and be like, yeah, no, I don't like that. Yeah, I'm going to try something else. I will be the first to argue that it shouldn't matter, right? As long as your risk is contained and you price is not going to hit your stop, why not just let it ride? That's the argument. I can't do it. I can tell you right now, if I get in on this reversal and price starts doing this trash right here, I will get out. I don't care that it finally runs all the way down here and hits my target. It stalled and did this trash, and I will get out. This price is not doing what I wanted it to do or what I expected it to do in a timely manner, and I just give up on it, get out. I don't care. But I have found that my P&L really appreciates that too. Like I don't get bad losses. I get losses. Believe me, I get losses. My win rate is less than 70%. So I'm hitting like 66, 68, but my risk to reward is really, really good. And I don't care, that I've got a plus 30 loss rate. I don't care. I've tried to make it better, but then I have to sacrifice my risk to reward. And I don't I'd rather keep my risk to reward. So I don't want to change anything. But that helps resolve a lot of problems. When people say, "Well, what's your target?" My target is my P&L. I'm looking at my risk to reward. So I want my 6 points. I want my 8 points. But if we start screwing around and doing some junk like that, I'm gonna get out. I don't care. Knowing that I do that, I never have to worry about, oh, you know, I messed this one up because I stayed in too long and it reversed on me and took me out. I should have got profits here. That I don't struggle with those problems. I get mad about it if I get out and it does work, and I say, well, you stupid thing, I should have just stayed in there. But at the end of the day, I still don't change that, and I won't, because I like my scenario. I hope you guys have a good weekend. Try not to get too cold. You guys out on the East Coast, there's a storm coming in from the ocean side, and it's supposed to be really bad. For us in the central US, I don't think any of us here is supposed to get any of the nastiness, but I won't be getting my motorcycle out, that's for sure. It's staying put. Yeah, I cannot believe snow in Florida. I did hear them say that on Bloomberg this morning, that it was likely to see some flurries in Florida. I just shook
Yeah,
my
all the way
head.
down to Tampa.
I
All the
can't
way down to
believe
Tampa,
that.
believe it or not. Yeah,
La-
yeah. I love it.
we had that big air pocket last year where it was colder in Florida than it was in Canada. I heard that last year too, when we had that cold snap. It was like what, September, October, something like that. But it happened last year too, and it didn't have any snow with it. It was just like this air bubble that was covering a couple of states. That's how big it was. And they were like, "Yeah, today it's colder in Florida than it is in Canada." I'm like, "What the hell? What is going on out there? Something's wrong. Somebody
Yeah, they said
broke it."
it's like a vortex. Yeah, it's like a vortex that's dropping down. But then on top of that, because of all the ice and all that stuff up in Mississippi, Alabama, Tennessee, all that area, it's just going to make it even colder. That's part of the reason why. And then it's running that cold air over the warmer bay, Bay Gulf. That's what's possibly going to produce it. The snow.
That's madness. That's why
Yeah,
we can't have something nice. Somebody broke it.
yeah. It makes you just can't go to the beach. But
Yeah.
they're doing the ice hockey arena though, or ice hockey for I guess the Lightning and another team. They're playing. They're playing in the Tampa, Bay Stadium outdoors, so it's going to be freezing cold, which is nice for them. You know, so the ice doesn't melt. They're doing an outdoors game, which is kind of unique because they have their own arena. So they're just it's like perfect timing for the cold weather for that.
I mean, at least they're able to take advantage of it, so it don't go to waste.
Um, Signet. I'm sorry, Stagnant. Signet. Quick question for you. Um, this pullback was out of the blue. I mean, not out of the blue, but you did call it out in terms of the market maker moves. That something was, but I couldn't really find anything in the news that would cause such a reversal like it did. Maybe it's like a rubber band effect, last hurrah to the downside before going up. I'm not sure, but I couldn't find any real news or catalyst that called it out.
The Trump tweets about sending ships to Iran was news that hit today. You can see the red on the screen here. They were hitting in finance juice. So those were part of the drop today. And then
Okay.
the government shutdown or lack thereof, and the replacement of Powell. Those were three big headlines in the last 24 plus hours that accounted for all of this drama. And then there was comments about rare earth and the administration's picking of the winners and losers, and that hit like MP and USAR and all of those rare earth plays. That bled over into precious metals, which bled into equity volatility too. But the big red headlines over the last 24 hours, they're on finance juice, and they line up with the drops.
Got it. Thank you.
Yep. I love that app. That market AI app, but finance juice. It's maybe it's just hitting the big stuff, whereas market AI is smart enough that it's hitting like everything out there. And so it all just kind of blurs together. What it thinks is big doesn't seem to be so big sometimes. And then, we get used to these red headlines on Market Watch or this Market Edge. It seems like every 10 minutes, it's got another red one, another red one, another red one. So after a while, we just kind of shrug it off, like, yeah, whatever. I guess these red ones ain't so much of a big deal after all. But you get those red ones on finance juice, and a lot of times they are the one that lines up with the price you see dropping. Plus, a lot of times on finance juice, they'll match the move with a chart. They'll show you exactly when the S&P fell when the announcement came out, and they'll have like S&P and the dollar, or they'll have the S&P and the yields in the same chart. I'm looking for one. I know they did it Wednesday. I was hoping they had another one before that. But that's nice because then you can see what the chart looked like when the news hit. And they even have the little circle and it'll show you like, oh, there was the drop. I posted one in the chat. If you guys was to scroll back to probably Wednesday, you would see where I took a picture of the finance juice where it had their chart and the news that had come out that shook the market. And that's really nice because they give you the chart and the headline so that you can put the two pieces together and be like, oh yeah, that's exactly what happened to the market. That was the reason.
Yeah, I'm gonna have to start. I'm gonna put financial juice on one of my links so I can get to it quick.
If you're gonna put this on your link, there's a really awesome tool in the corner up here. You don't need to buy it. You could, because it is a thing that you can buy, but the free one is just fine. It's called Tick Strike, and it makes noises when order flow picks up. Now, if you're only using the free one, you don't get a lot of choices on the markets you can choose to apply it to. I leave it on the S&P 500, and because it's free, it's not picking up everything like a paid version would. The reason I like it though is I multitask. I'm doing a lot of things. And if I am, say, reading an article and I'm not watching price anymore, I click this, turn it on, and then I'm reading my article and it starts making noise, I know we're getting flow. That's all it is. It just, hey, kind of, it's like someone tapping me on the back of the head, say, hey, look up. And I stop reading whatever I'm reading and I go look at the chart to see what kind of flow we're getting, what's happening. And it's just this little button right up there in the upper right, and it's free and it doesn't cost you anything. It can be annoying if you leave it on all day. So I don't leave it on all day, but there's times in the day, like I'm eating lunch, I'll turn that on. Or if I've got something really big to read, I'll turn that on. I don't have to sit there and worry about what's happening in the charts.
That's cool. I'm gonna do that.
It's also a good
Thank you.
idea if you're going to use Finance Juice, you can make a free account. You don't need to buy um, the a subscription to have an account here. So if you open a free account, you get to use this button, which is the filter, because this is a news aggregate website. It's getting news from all over the place. And that's cool, but it kind of sucks because it's going to bring you Fox and MSNBC and CNN. And I don't know about you, but I don't want any of that trash. And it just is, it's a waste of my time. So if you have a free account, then you can use the filter and you can turn all that trash off and save your settings so that you don't have to do it again. And that way, every time you come over here, you already know CNN and MSNBC and all that junk is automatically going to be hidden and it won't show up in your newsfeed.
Great. I'll take a look. Definitely. Thank you.
It's free. So make a free account and you're good. This picture is from Finance Juice. I believe it was the CPI from the other day, but it might be from something else, but it's from this week. And you can see the blue circles. That's when the news hit. So they had the red tag on Finance Juice, and then they published the chart right behind it. This one happened to have the European Stoic 600 and crude. Sometimes it'll show the dollar and yields, or it'll show just the yields. So you're never quite sure what it's going to have with the S&P, but it always has the S&P. I love these charts when they do that because it shows exactly what was price doing when the news hit. Really handy to have.
Thanks again.
Yep. So I hope y'all have a good weekend. Be careful. be safe. If you guys have topics you want to get, then hit me up. We'll add them to the list. I still have some topics. Um, we're gonna go through how to find a watch list of liquid options, and you can update it daily if you want to. I do it every other month or so, but it's going over to the CBOE and downloading the list of all the markets that have options and how much volume they had for the month. And then you choose how many names on that list you want. You just grab the top 10, the top 50, the top 200, and you'll know that those are the most heavily traded things in the last month. And that's your active trade list because, well, it was the markets that got the most activity. So we're going to go over that at some point next week. And then there is economic events that are coming at us. And if you want to get some swing trades, you need to be mindful of the economic calendar because we got some bad stuff headed our way. We're done with those two. I can actually take those off. We're done with FOMC now. We can take that off. Next week we got QRA, and then we have some snap elections to deal with and OPEX, and there's more that isn't even on here, but that's something else we'll go into next week is the economic events that are on the calendar.
Hey, Signet, quick question for you. Is there videos in the Bullish Bear website that covers how to for Discord? Like, I know you guys have talked about, and you've mentioned it several times even today about putting information in Discord to track your trades and, the different patterns and different things like that. Is there like a how-to that you guys have on that in here, to creating that, like group or what have you in there in Discord?
Not that I know of. I know Kevin and Marziti have both done Discord videos on like setting up your audio and that sort of stuff, but that's more of getting people to participate in the live stream kind of videos, right? They wouldn't be helpful for that sort of a thing. What I've always recommended is, I've got Teams, I've got Slack and Discord, and they're all kind of the same, but they're different and they have little different aspects. I learned to use every one of them just by jumping over to YouTube and watching a couple videos. And to start a new Discord, you just hit that plus sign right there where it says add a server. From there on, anything that you would want to do, it would be just to ask AI or hop on a video on YouTube, like how do I add another channel? How do I do whatever? But running a Discord, once you make one, you just kind of grow with it. I learned more about Discord by having my own server than I did from watching any videos about Discord because I was able to just play around and try different things and test out and see how to do different stuff, how to change the fonts and the
Thanks.
formatting and all that. But making channels and making Discords is easy, and you can make 100, I think, before they want to start charging you. I don't have 100 Discords, but I've got over 50.
I know they're going to be IPO and soon, from what I understand.
That is awesome. Maybe after they IPO, they're going to really start cracking down on all of these scammers.
Well, hopefully they don't start charging us to use it.
Yeah, that's a concern because Teams ain't free and Slack ain't free. You know what I mean? Like, I have Slack, but I don't really use it that much because it's not free. So yeah, that will suck if Discord moves to not being free anymore. But I don't know that they would do that because they've got so many young people who use it because it connects to their Steam and their Xbox, and I think they would be unwise to lose that client base. Get them when they're young, right? To where they get really comfortable with Discord and then they turn into adults and they're using Discord in their adult life. That would be the smart thing to do, not to start charging them and then lose that client base and then have them grow up using some other app and then you don't have that product base anymore. That would be very foolish of them to do that.
Yeah, either that or they're going to start adding advertisements when you come into it, or some sort to make revenue?
Well, I mean, they got the nitro. They make money now. They make money from me anyways. I spend 150 a month on Discord. I'm sure I'm not the only one out there, but you know, the quality of our live streams, how many people can join the live stream, the audio quality, like, all that stuff is connected by your nitro level. Having this advertisement up here at the top left, all kinds of things. How many emojis we can have, how many special emojis, all sorts of stuff based on our level.